What I'm going to do over the next 15 minutes is just identify and illustrate some of the issues in the global economy in particular, and some of the concerns that are there, and some points you need to watch during the course of this year. Now, obviously, the economics profession has been brought into disrepute over the last 6 years because of the global financial crisis. So I am obligated to warn you. This is known as the legal and visual disclaimer for the economist profession. So you have to take what I say with a large grain of salt, so to speak. Now, to kick off, it may surprise this audience that, bearing in mind that economics is the dismal science, that I am mildly positive at the moment. That in itself might be a cause for alarm. But what you can see in terms of the American economy in the next slide is that there is considerable scope for the American economy to surprise on the upside in terms of economic growth. What we have to bear in mind is, because the crisis was so deep, the global financial crisis, or what Americans consider the Great Recession, what happened in terms of the housing market was quite dramatic. And to illustrate that, if you look at the graph there, just to show you, the blue line represents house prices, the Case-Shiller measure of American house prices, and the red line represents housing starts, also known as housing construction, so the building of new homes. And if you look at the start of that graph, you could see that house prices in terms of the index were about 225, and housing starts, the red line, were about 2 million units, okay? And obviously, because of the crisis, those indexes both collapsed. In the case of house prices fell to a low in early 2009, something like 35% below their 2006 level. And the more dramatic impact was actually in housing construction, the red line. So housing construction fell 75%. Now, what you've seen over the last 18 months or so is a very solid recovery in both those indexes. House prices are up about 14% over the last year. Housing starts are up something like 20%. Now, we have had a weather impact in the United States. January and February data has been distorted by the cold weather that's occurred. So that red line has come off the boil a little bit. But all things considered, given the level that we are now at, compared to where it was 2006 prior to the crisis, there's considerable scope for the American economy to surprise on the upside. We are only at the early stages of the housing recovery story. We also have an environment where both monetary policy, so interest rates are near zero, the Federal Reserve is still buying assets, so the asset purchases or the quantitative easing program, buying mortgage-backed securities and government bonds, that's still intact, and it's only gradually being tapered at the moment. We also have fiscal policy in America, which is no longer aggressively tightening. Now, last year we had what's known as the fiscal cliff, which was a budget tightening about 2% of GDP. This year, it's going to be closer to 0.7% of GDP. So there's less fiscal tightening in the American economy. So all things considered, American economy is going to surprise the upside over the next couple of years, and that's really our central expectation. However, if we look at the next slide, there are still some lingering concerns about Europe. Now, what's happened in Europe is that essentially the banking system, which is the key provider of credit to the European economy, is still very fragile. What we can see in terms of the red line there is bank lending in Europe. And what it shows is that that red line is below zero, so bank lending is still contracting in Europe. It's similar to what was occurring during the global financial crisis. So European banks are essentially cutting their loan exposures to both corporations and households. There is some concerns about the quality of European banks' balance sheets. At the moment, the European Central Bank is conducting what's known as an asset quality review of the European banks, the largest 128 of them. So it's going through the books and it's testing whether those banks have made reasonable provisions for their doubtful or non-performing loans and whether they have sufficient capital to continue operations. Now, we only get that announcement of the results of that review in October of this year. So there is potential for some negative surprises out of the European banking system. What we have in terms of the recovery in Europe, we have a very gradual but a very fragile recovery because of the banking system problems. So it looks like Europe's going to grow at about 1% growth this year, but it's largely a Germany, Northern Europe story. Southern Europe is still essentially stagnating, or in some countries like Greece, still in a recession-type environment. So you need to watch the European banking system. Now, the problems in terms of credit availability, or the lack of it in Europe, the next problem is actually the reverse, and that's the case with China. Now, what we can see in terms of China is that arguably we have a credit bubble. The blue line shows you bank lending growth in China. Now, we had a big spike with the stimulus programs that occurred 2008, 2009. Credit growth went up quite significantly. We've had a slowing down or a moderation in credit growth, that blue line, over the course of the last 3 years. But the level of bank lending growth is still well above nominal GDP growth. So bank lending is growing around 13.5%, and the government's target for nominal GDP growth is about 11%. So arguably we have a credit bubble that is continuing in China. Now, it is a very confusing backdrop trying to gauge what is the Chinese central bank's intentions, both with the banking system, the formal banking system, which that blue line represents, as well as the shadow banking system. Now, the shadow banking system is the trust companies, investment management companies that are providing finances to both the state-owned enterprises as well as the local governments. There, the credit numbers are actually higher than that blue line. Credit is growing at a 17% pace. Now, normally you would expect, if the central bank wanted to slow down dramatically that credit growth story, it should be raising interest rates. Now, in terms of the formal measures of interest rates, it hasn't made any move in the last 18 months. The red line there represents the Chinese interbank 7-day repurchase rate. So this is a very short-term measure of liquidity in the banking system. And what you've seen is these occasional spikes where the Chinese central bank has signalled that it's trying to tighten up liquidity. But in the last couple of weeks, that red line has come down quite dramatically. It's gone from 5.5% to 3.5% currently. So we are all trying to understand what is the Chinese central bank's intentions in terms of credit growth and financial stability. It is definitely the case that credit needs to slow down to ensure sustainable growth in China. But at the moment, it's very hard to say that China will go through a credit crisis, even allowing for the default risk of some of the trust companies, without the Chinese central bank dramatically raising interest rates. And at this stage, we're not quite there yet. Now, just turning to the Australian economy, we've had the most extraordinary mining investment boom. In fact, the Reserve Bank has called this a once-in-a-century investment boom. And just to try and put that in perspective, if you look at the graph there of mining investment as a percentage of real GDP in Australia, if you went back to around 2005, mining investment was 1% of GDP. Over the course of the subsequent 7 years, it's climbed above 6%. Now, we are at that top end of that graph at the moment. We are starting to see signs that mining investment is trailing off. The continued trajectory of that blue line coming down with that green arrow is the big question mark for the Australian economy. How fast does it come down? And does the Australian economy have other potential sources of growth to fill the gap after mining investment falls away? Now, I've just taken a quote from the Reserve Bank because they've given a sign that they expect mining investment to basically go from 6% of GDP to 3% of GDP within a 2.5-year time frame. So what that means is that essentially it takes about 1% off Australia's GDP growth, economic growth, per year. So we have to find other sources of economic growth to fill that gap at the moment. So that's the big question mark. Now, I don't want to leave you all pessimistic. There are some encouraging signs that the non-mining economy is now starting to perform to fill that gap. The chart on your left-hand side is Australian retail sales. What you have to bear in mind, it's a very volatile time series. This is the annual growth in retail sales. I must say we should employ a Chinese statistician to smooth out this sort of volatility. But what you can see for the period 2010 to 2013, essentially, that red bar indicates that retail sales, the average growth rate was around 2.7%. If you compare it earlier in the graph, prior to the GFC, retail sales were growing at 6%, so more than double the pace. Now, what we've seen in the last 4 to 5 months, you can see how that blue line is now starting to take off, okay? So what we're seeing in terms of consumer spending is very, very encouraging. So despite the job loss announcements that we've had, despite the reasonably soft consumer sentiment that we've had, consumers are actually spending. The chart on your right-hand side shows you the housing story. Now, the green line represents house prices, and as you can see, house prices over the last year or so have risen quite strongly. They're up close to 10% over the past year. So that's a positive wealth effect. That'll feed back into the retail sales story. As well, the blue line shows you new housing approvals. So new housing construction, the blue line, you can see how that's taken off with the Reserve Bank cutting interest rates. So we are getting these encouraging signs that the non-mining economy is starting to fill the gap for the Australian economy. So it looks like after a very subdued performance, they're coming back. So hence, from the point of view of the Reserve Bank in terms of interest rates, it looks like the Reserve Bank is done in terms of cutting interest rates. So when we look at the blue line, which is the Reserve Bank's cash rate, and what you've seen, we've seen a cycle over the last 2 years of gradual cuts in the interest rates down to a low of 2.5%. Now the red line is a measure of leading indicators. So it's a gauge of how well monthly measures are doing. And what we're seeing is that that red line is now starting to pick up. So the building approvals retail sales, business confidence indicators are now turning up. So if there is one bit of useful advice in this presentation, and I am being ambitious here, is that you should be thinking about locking in your mortgage interest rates, because the chances are that the Reserve Bank will be contemplating within the next 6 months raising interest rates, because we're getting an economy that is now surprising on the upside. Now, just to finish up, so the global economy story, the US economy is now due to surprise on the upside. The housing market, house prices, housing construction, has got plenty of scope for a recovery story, and we've got very easy monetary policy and less tight fiscal policy in America. So it looks like America's growth is going from the 2% growth rate that was averaged over the last couple of years up to a 3% type growth rate. The European recovery, it's very gradual, it's very fragile. It is going to manage a 1% type growth rate. So the global economy story is improving. The question mark for all of you is, in terms of being a share investor, is has that global recovery already been anticipated? Okay. And in some cases it has. In terms of the Australian growth story, the mining investment, how rapidly it falls away is the great unknown at the moment. But we are getting positive signs out of the non-mining economy that it's starting to fill the gap. And because of that, it looks like the Reserve Bank is done and dusted on cutting interest rates.
My inclination is to try to draw out what Bob's reading of the world economy and the Australian economy could imply for investments over the next 12 months. I have to say, I think the picture he's painted is a reasonably encouraging one for investment returns. Like Bob, we're not inclined to get too carried away, but I think the environment of improving economic growth, albeit in a sort of incremental fashion globally, with the United States growing a bit more strongly, Europe growing again, even though not robustly, but certainly not contracting as it had been, and China continuing to grow at a strong rate. And then in Australia as well, the potential for the economy here to continue to grow, I think is quite favourable. I'd also say that inflation is very low in most of these parts of the world as well, even unusually low. And as Bob mentioned, monetary policy is very accommodative still and isn't expected to be tightened at least for the time being, although, you know, that is coming at some point in countries like the United States and possibly here. So in terms of the potential investment returns, that's usually a reasonable period for returns in shares. And I know we've had a couple of very good years in shares in Australia. But at Citi, we're expecting another reasonably good year, not as strong as the past two in the local share market, but above average. And I want to spend a fair bit of my time talking about that, giving some colour on our expectations there, given that shares tend to account for a large part of investment portfolios. In bonds, we're expecting yields to be drifting higher, but not at this stage aggressively so. But obviously that's something that has to be watched, and that is a bit of a risk to all investment returns, I would say, at this point. I wanted to talk a little bit about company earnings in Australia. There's some numbers on this chart. I hope you can read them. I'll confess or indicate this is the most busy picture I have, so don't be too concerned you're going to get overwhelmed with statistics here. But I think people might find it a little bit of a surprise that corporate earnings in Australia are actually growing pretty strongly at the moment. The table I have there, there's 5 columns you can see. The 3 on the right are the expected and actual and expected growth in net profits of Australian companies, listed Australian companies, actual in fiscal 13 and expected in fiscal 14 and 15. And as you know, or you may know, we're halfway through fiscal 14 for a lot of companies. We had interim results for the December half year in February. And so the columns on the left just indicate the run rate at that point. And what you can see is in the current fiscal year, we're looking at mid-teens earnings growth for the market. That's pretty strong by any standards. And we know from the December half, we've had 14% growth delivered. So that forecast for the full year is, a reasonable number at this point. And that follows what was a pretty weak fiscal 13 with earnings down a fraction. The big change is pretty evident. It's that the resource sector, which is a quarter of the share market, is on track to deliver about a 40% increase in earnings. Now that's coming from an expansion in production, which is the result of the mining investment that Bob mentioned, that's been going on for a number of years. The fruits of that are now coming through, particularly in iron ore. We've also seen steadier selling prices for mineral exports in the last 12 months, and that's helped as well after a couple of years of heavy falls. On top of all that, the sort of challenging times the mining companies have had have encouraged a big focus on costs. So that's also helping profit margins. And then the decline in the Australian dollar helps as well, because big companies tend to have a fair bit of their operations in Australia, but because they earn or they sell to the world, their cost structure tends to fall. If you look beyond the mining sector, you can see the other parts of the market that I've divided the earnings into are also seeing pretty good growth in the high single-digit territory. The banks, which account for about a quarter to 30% of the market, and then the rest, which I've called other financial or other non-financial. It's interesting, I often use a slogan at the moment, which is that S&P is not GDP. And Bob's talked about a moderate rate of growth in Australia, but we're still seeing reasonably good earnings growth outside of the resource sector. And it's not just this year, we had it last year as well, you can see from the fiscal 13 numbers. And what that owes itself to is the other factors that affect corporate earnings other than just trading conditions in Australia, and they include what companies are doing on costs, which has been a big focus also outside of the resource area. It also depends on capital markets, because there is a big financial sector in Australia and capital markets have been a bit healthier. And it also depends on what the currency does, because about, even outside of the resource sector, about a fifth of the earnings come from abroad. And if you do a split between the onshore and the offshore earnings, that's where you get a clearer sense of how the more subdued domestic economy, particularly outside of mining investment, has weighed a bit so far. If we look at fiscal 15, which is going to be very important for the market advancing further, the share market going higher, we're looking at a sort of another year of reasonable growth. This is increasingly what investors are focusing on now, given fiscal 14's fairly well progressed. And a fair bit of that growth is expected to come from the non-financial companies outside of resources as the economy rebalances, as Bob described. I think there's a reasonable prospect of that, which is why I think these numbers are fairly credible at this stage. So the main reason we're expecting fairly good returns in the share market again, and the returns we're looking for are in the order of about 15%, including the yield. So about a 10% advance in the market, slightly lower, and the yield, and that would be above the long-term average of about 10%. We're expecting them largely because we see this earnings growth as more promising at the moment. The valuation of the market is neither really here nor there, you could say. It's not modest anymore because of the gains in the past couple of years, but neither is it extreme. And the picture there just shows you, along the bottom, the earnings growth over the years, over 25 years, with a few forecasts there from the consensus of all the company analysts in the market. And you can see there that the growth we're getting at the moment is a little bit atypical of the period since the financial crisis, because we haven't really had much earnings growth in our market for quite some time, apart from 1 year when iron ore prices rebounded. But we do look like we're getting it now because of that investment in mining coming to fruition, because of the pickup in the world, albeit gradual, and because the economy is rebalancing here to broader growth again. The market PE is the blue line there, and you can see that's back to a reference point that I think is quite useful, which is the average of the past 2 decades. That's the era of low inflation, targeting low inflation, and low yields on investments generally. And we're right on the average there, so I don't see the market as too dramatically or extremely priced at all. Having said that, if you look back to 2012, the price to earnings multiple was quite a lot lower, and that provided the foundation for the 20% type returns we've had for the last 2 years. So we don't see that continuing, that sort of return rate, but we still think there's potential for a reasonable year. And we see similar prospects in the major markets around the world, the major equity markets. The other interesting feature of the share market is when you look across the market, and I've shown here a picture of about 12.5 industry sectors which tend to comprise the share market. This is their price earnings multiples. They're actually fairly convergent at the moment. It may not look like that. In fact, there's a gap of about 10 PE points between the lowest and the highest, but that's actually fairly narrow. Sometimes it's even more dramatic than that. And you could say that a lot of the parts of the share market are fairly normally priced at the moment. And what that's telling you is that there's a belief in broader earnings growth than there was a year or 2 back. And that growth is tending to manifest, so there's some justification for these valuations. What they make it difficult to do is to highlight opportunities of divergent relative valuations. You can look at the picture and see most sectors are sitting around about the market average or thereabouts. Whereas if you were to go back 18 months to 2 years, some sectors were quite depressed on lower than 10 times type multiples. It makes it harder to identify value from here, but these price earnings multiples, what they hide is what the earnings potential is, and as I've shown in some of those earlier pictures, the growth in earnings in the next couple of years at least should be okay, and the more cyclical parts of the market should benefit from the rebalancing that Bob talked about. And so they're areas like retailing, media, transport, construction materials, including steel. The other interesting area is mining itself, where the price earnings multiples are the lowest in the market. So in a way you could say if there's any divergence in value, it is tending to be in the mining or mining related areas like chemicals, which these days is more explosives than anything else, and the construction contractors. I would say as well, equity valuations are pretty reasonable compared to bonds. You can see, just looking at relative yields, the gap that's opened up since the financial crisis from around 2008 is still there to a fair degree. There's a fairly generous gap, if you like, and in our mind it leaves some capacity for the equity market to cope with rising bond yields up to a point, depending on how sharply they rise. But based on the sort of sense that the growth pickup globally will be incremental and that inflation is still quite low and that central banks won't be needing to tighten imminently, although that is something that needs to be watched, we think the equity market can cope with some weakness in bonds, and the weakness in bonds probably won't be too drastic. I guess the risks around that, we started to get a sense of that last week when the Federal Open Market Committee of the Federal Reserve held its sort of 6 weekly meeting. The new chair gave a sense that the policy tightening that the Fed will have to undertake at some point, which has generally been expected to happen in the middle to the latter part of next year, could be a fraction earlier, although it's not clear she wanted to convey that message, but that's what came through. And that does give a little bit of a sense that one of the risks to this sort of positive type of scenario is that monetary policy might have to be tightened a bit sooner than the current consensus, and Bob flagged that risk in Australia as well. I just thought in relation to the United States, on the left there's a picture of bond yields and the overnight rate that the Federal Reserve sets, and it's got a couple of scenarios going forward. The pink one is basically what the markets are expecting based on the way they're pricing futures. The brown one is just more of an academic estimate of what the Fed would typically have done in the past based on its expectations for unemployment and inflation. Now, the Federal Reserve's been telling us that it thinks things are a bit different in this particular period, but it's always worth remembering, you know, these risks are there, that things can happen sooner. And on the left, there's a picture there of the unemployment rate, which is coming down probably faster than the Federal Reserve anticipated, which is a positive, of course, because the economy's doing a bit better. And the red line there is the rate of growth in wages, which is picking up a little bit also, which again is a very positive thing initially because it improves ordinary Americans' income growth and their standards of living as well as their spending. But at a certain point, they're going to have to get away from this very loose monetary policy. But as I said, for the time being, it shouldn't drastically threaten markets. And then finally, what is also always important for Australia is what happens in the commodity markets, because a quarter of the share market's earnings depend on those. And I think the pickup in the world's growth is also more positive there. You can see in that picture the rate of industrial output growth globally is a very good guide to what happens to metal prices, and metals are one of the key industrial materials and something important that we export. And we've had about 2.5 years where those prices have been under downward pressure, largely because the red line, which is the world's industrial output, has been running below trend, which is about 3%. But the expectations are that it's already come back to trend and a bit higher, and it should be able to sustain that. I should be careful to say we're not expecting a big recovery in commodity prices, because the other thing going on, the industrial output just reflects the expansion of demand year to year for materials. We've also got a lot of increase in supply occurring around the world, as that investment in Australia is partly behind. So it's still unlikely that prices will go up much, but there's some potential for them to come off a bit less than they have been doing. So just to finish up and leave time for questions, we think the environment we're in is still a reasonably good one for investments, particularly shares, which tend to be the larger part of portfolios. And as I said, we're looking for returns in the mid-teens again, though not as strong as the last couple of years. Bonds won't be as helpful, but shouldn't weaken too sharply. And the risks around this primarily being how quickly monetary policy changes course in the US and to a lesser extent here in Australia.